Well, hello everyone, and welcome to the latest edition of Conversations with a Pro Trader. I'm your host, Greta Wall, and with me today is Patrick Hawe, professional trader with T3 Trading Group and a moderator of the Pro Desk virtual trading floor. Thanks so much for coming back today, Pat.
Of course. Thanks for having me. Glad to be here.
Yes. All right. So for everyone who is new here, this is a live discussion between myself and Patrick about current news happening related to the market and his own personal trading, but also a Q&A event for you to ask Patrick your questions. So I'm putting in a comment in the live chat now, just so you guys can see where that is, to go ahead and submit your questions for Patrick during this first half as they come up. And then in the second half of the event, I'll make sure to ask him all of those. So anytime you think of one, just go ahead and put it there in the chat and we will get to all of them. Okay, Pat, you've been here before, so you know my first question is always, how would you grade your week of trading so far? We're halfway through. So give me your grade on a typical A to F kind of school grading scale.
Sure. Yeah, I give myself a B plus this week. It was a good week. It's been a good couple weeks from the bounce back from lows, which happened not this past Friday, but the one before that.
Mm-hmm.
Not an A because I could have captured more. I could have done a bit better. There's always room for improvement. I'm probably never going to give myself an A plus or anything.
Right.
So B plus, I mean, it was a good week. It could have been better, but it wasn't a bad week. So can't give myself a bad score.
Do you feel like you've, gone into this week with a plan that you've executed on, followed your trading rules and everything that you've set out for yourself in your
Yeah,
own
for
personal
sure.
strategy?
If anything, I wasn't quite as active this week. It was more active last week we finally had some market volatility for the first time it seemed like all summer really.
Mm-hmm.
So it was more just going off the plan of last week, which we came into pretty aggressively, just trimming trailing positions, managing positions, stuff like that. But yeah, so far, no complaints, except I should have bought more lower, obviously, but that's always going to be the case. So.
Mm-hmm. This week is the last week of August. It's kind of when a lot of traders might go on vacation and not
Mhm.
be so active. Have you noticed that the volume in the market is a little lower this week, and maybe that's not creating as many opportunities as normal?
For sure, especially it's been a good couple weeks, but especially the second half of August, especially the midday trading has been very, very slow. We'll
Mm-hmm.
get some morning movement off the open, maybe some pre-market action if we have some numbers or something like that. Um, Earnings are kind of winding down as well. So yeah, definitely this week, last week, midday, even into the close really has been really slow. Especially Mondays and Fridays too. Everyone's extending their weekend and whatnot.
Yeah.
So yeah, definitely not as, I mean, there's still been opportunities, but the midday, like day trading stuff has definitely been a lot slower lately.
All right. So let's get to uh, the news of this week,
Hmm.
which is focused on some key data for the Fed in their fight against inflation. This week's all about the labor market and then a little bit of inflation coming up too. Job openings came in lighter than expected on Tuesday. Private job growth was weaker than expected this morning. What do these types of reports signal for the market when it comes to the Fed and their policy?
Yeah, so yesterday was Jolts. Today's Wednesday,
Mm-hmm.
right? So yeah, yesterday
Yep.
was Jolts. Jolts was a big miss. I wrote it down
Yeah.
just to not forget, but we came in at 8.83 million. We were expecting 9.49 million. And then
Mm-hmm.
this morning for ADP non-farm, came in at like 177K, expected 194K. So today was pretty solid. Yesterday was a huge day to the upside, though, which was a nice treat for people that were long off the near bottom from the last week or so.
Mm-hmm.
Um, it's kind of back to, and this market flips. It's been flipping this whole bear market the past year plus, where, good news is good news, bad news is bad news is good. We keep flipping depending on the data looks like, what interest rates are doing, what Fed fund futures are doing. So yesterday, that JOLTS number just skyrocketed the market higher. So for now, it looks like bad news is good news. The economy is starting to turn down a bit, possibly at least slow down. Doesn't mean we're going into a big downturn or anything yet per se, but that lets the Fed kind of take their foot off the gas in terms of tightening. So
Mm-hmm.
right now it looks like it's bad news is good news, where we get bad economic news that should be bad, but it lets the Fed, possibly not hike in September, possibly not hike in November, possibly be done hiking. So therefore, equities like it in the short term.
Mm-hmm.
Whether they'll like bad economic news a month out from now, we'll see. But for now, it looks like it's good because again, lets the Fed take their foot off the gas for tightening.
Totally. Tomorrow morning, we'll get the Fed's preferred inflation gauge, which is the core PCE price index coming out for the month of July. The CPI already came out earlier this month for July, a little bit lighter than expected, which was good news for the Fed and for the market. What are you expecting from tomorrow's data and then the market reaction to it?
So it looks like PCE, we're expecting 3.3% year over year, 0.2% month over month. Inflation really hasn't been the hot topic per se over
Mm-hmm.
the past, I don't know, really since we've topped out there. And then it's been just such a steady trend down for the most part up until I think the last CPI, we were a little bit hot. Core was a little bit hot as well. And
Mm-hmm.
core has been sticky as well. But for the most part, again, the market trades off of like themes and kind of, what's cool oftentimes. So like,
Mm-hmm.
AI was obviously very cool this summer. If you were riding the AI wave, you probably did well for the most part. So for now, it seems like inflation really, not that it's not a worry, but it seems like we've moved past the worries of inflation onto the worries of the economy and how much all this tightening is going to affect the economy going forward.
Mm-hmm.
Obviously the biggest hiking cycle we've had in a long time. Rates are at like 20-year highs or whatever. So it's not that I'm not really expecting or looking forward to much tomorrow, but I think it'll more be kind of a non-event, really.
Mm-hmm.
It seems like, for a while we were moving so much on CPI numbers and the jobs numbers. We didn't talk about too much. Jobs just kept holding up, holding up. And
Mm-hmm.
now, even the last CPI number, which was a little hot, it wasn't really that big of a deal. Then you see the jobs numbers yesterday and today, and the market roared higher. We went like 100 handles higher yesterday. Um, so we'll see what it's like tomorrow, but I'm not hyping it up too much, as more as Friday's jobs number will
Mm-hmm.
probably move us a bit more
Yeah.
dramatically, I would think.
Yeah, so you mentioned it. Friday is kind of the big day this week. That official August jobs report coming out 8:30 a.m. Eastern, so before the market
Yep.
open. So I think I know your answer. You kind of already said it, but do you think this month's jobs report holds more weight than previous months because of the approaching Fed decision and that the Fed has said they're so focused on the labor market uh, versus inflation, maybe at this point?
Yeah, so Friday's number, I think we'll get more immediate volatility off the number as opposed to
Mm-hmm.
like PCE tomorrow morning, where that doesn't mean we have to go up all day, have to go down all day, but just the initial reaction, I think will
Mm-hmm.
be bigger Friday morning. However, I think it's also going to be a little bit tricky for this jobs number because we just had two jobs numbers that were both weak misses. The market reacted off both of them. Again, yesterday was like a really big day,
Mm-hmm.
to the point where we had an like a intermediate downtrend that we broke yesterday. So tomorrow, I'm or no, sorry, for Friday, the jobs numbers, I'm sure people will be looking for a weak number, but we just got two weak numbers. The market reacted off them. That was possibly front running that number, which the market is often usually tricky, right? So if we have two weak jobs numbers, the market goes up, and then everyone thinks we're going to have a third weak jobs number, and therefore the market's going to go up off of it. It's probably not going to play out that way.
Mm-hmm.
So it depends where we are, I guess, after tomorrow. But after today, we're honestly a little bit extended to the upside. We could probably use a rest. So if we rest tomorrow, we could go up on a weak number on Friday.
Mm-hmm.
If it's strong on Friday, that's probably the biggest downside risk because people aren't going to
Yeah.
expect that after this data coming in. So yeah, it should be interesting, but it might be front ran into if we get like I won't be surprised if we don't roar higher on a weak jobs number, just because that's basically what we did this week off of the
Hmm.
same concept pretty much.
Do you think, what comes out in the jobs report is not just, hey, we added 190,000 jobs. It's also the unemployment rate, average hourly earnings, which has been a big deal for the Fed, labor participation rate as well. The Fed has said they want to see the unemployment rate rise. So do you think there's more focus on maybe that portion of the report versus just the total number of jobs that are added in the economy?
Yeah, that makes sense. I think they want to see, especially with like the unemployment that you're mentioning, not necessarily one number over the other, but more just a trend starting, and
Mm-hmm.
not that they want to see a trend of unemployment, but they want to very closely monitor if we get a little bit weaker, but they don't want it to turn into a trend that's uncontrollable and can
Hmm.
spiral out of control. Because then it all of a sudden is going to look like the Fed tightened too much, and the Fed
Hmm.
is always to blame for everything pretty much. So that's
Yeah.
when, we might have a little recession and the Fed will be blamed for raising interest rates too much after they were blamed for not raising them fast enough because they were blamed
Hmm.
for inflation. Um, so yeah, I think they'll be watching for trends specifically. And if it's uptrending a little bit, but it's okay, they won't mind that. That's really what they want. But they just want to see it not start to get out of control, which
Hmm.
that's kind of the area I think of like this bigger business cycle we're coming into. We're pretty much done raising rates, maybe a little bit more. And now we kind of go into the holding period and see how much damage the Fed is going to do or has done with the lag
Hmm.
effects that come in.
Talking about race, after the Fed chair's speech at Jackson Hole last week, when he said, they're kind of basically leaving the door open for more rate hikes, which is what he said at the past two meetings as well.
Mm-hmm.
CME Group's FedWatch tool still shows over 88% of traders expecting no rate hike on September 20th, especially after the lighter than expected jobs data this week. That number went up. The possibility, though, still there of maybe one more before the end of the year, kind of 50-50 if you look ahead to the next two meetings. How are you feeling about the Fed's future plans this year?
Yeah, so I haven't been following Fed funds futures as much as I used to, just because they've been so wrong so many
Wrong.
times throughout this past year. I
Mm-hmm.
remember when we were doing this in the spring, and I think even this spring they might have had a rate cut
I think they had
possible for
four
like
rate cuts back
right
in.
by the end of the year. So
Yeah.
like next month, September, we were supposed to cut rates. Now we're
Mm-hmm.
possibly, maybe gonna hold, maybe gonna hike.
Mm-hmm.
So yeah, I haven't been paying as much attention to them because they've just been so wrong in term and because no one really knows, but that's what makes a market. Everyone kind of trying to figure something out, and one guy thinks he knows more than the next guy or whatever. So it looks like we'll probably pause in September, and then I guess they're just leaving up a chance that we hike in November
Mm-hmm.
if all the data keeps rolling in perfectly. But so far over the past month or so, the data hasn't been rolling in as perfectly as it was the
Mm-hmm.
first half of this year, where it was just a pure downtrend in inflation and everything else pretty much picture perfect, like Goldilocks is what
Mm-hmm.
they call it.
Mm-hmm.
So we're already seeing some weak jobs numbers. We saw core inflation a little bit sticky, not really go down as much. And there's been little misses here and there in the data that are kind of starting to dwindle out a bit. So they we'll see if they hike in September. I don't really see a reason that they need to. And then by
Mm-hmm.
November, that should be enough time where the data is either clearly going to start to roll over or clearly going to keep holding up.
Mm-hmm.
Um, so we'll see, but I don't think we might be done hiking rates at this point. I probably
Mm-hmm.
wouldn't have said that like a month ago, but seeing the weaker data come in and everything, yeah. So
Yeah.
we'll see. But definitely by that November meeting, we'll have plenty more data where it's clear we're still roaring, or it's clear we're like actually slowing down. And in my opinion, it seems like we're starting to actually slow down a little bit. It just kind of feels that way.
The Fed chair has really emphasized the higher for longer portion of the Fed's policy, trying to tamper down the market's expectations of any rate cuts anytime soon, even in the beginning half of 2024. How damaging do you think these high rates staying this high for a long time, talking about, on banks, looking at the bond market, how damaging can this be for, those portions of the economy and the market?
Yeah, I don't think it's too damn it because we're not, sky high over 10%
Mm-hmm.
wherever we were in like the 80s. Um, but so it was kind of more getting back to normal, and then we seemed to have pushed the normal to the upside a little bit because we had to tamper inflation. Like
Mm-hmm.
rates, and people always argue that since '08 rates don't belong at zero, it's not normal to have just 0% interest rates all the time.
Yeah.
And that's part of how so much fluff came into the market in the first place.
Mm-hmm.
So so like it's not that I don't think it's damaging to everyone, but is it damaging to people who might have been irresponsible with finances when rates were zero? And took out too much debt that they, thought they'd be able to pay off. There's a lot of things like that that I still think might come to fruition over the next year or so. The Airbnb rentals, everyone
Mm-hmm.
renting an air, buying properties and renting them out, thinking they're going to be rented all year and stuff like that.
Yeah.
Um, so yeah, I don't think it's overly damaging. It probably will damage people that were irresponsible, but that's kind of just how the cycle goes.
Mm-hmm.
And then we'll see if how bad that is, if that trickles over to Main Street, as they call it.
Mm-hmm.
So I think it's okay for now, really.
All right.
And if anything, there's arguably still fluff that should be washed out in the market. So it's probably, short term bad, but like bigger picture, an opportunity. So
Hmm.
I don't think it's too bad. Yeah.
You mentioned earnings season is still, winding down as we're coming into the end of mostly second quarter earnings season. What's been your assessment of this earnings season as a whole, and kind of looking forward to this next quarter, the current quarter that we're in? What might the market be focusing on for those results?
Yeah, so that's another good point for why we might be I don't even want to say turning down, but just slowing down on the upside, and things might be taking a turn. A lot
Mm-hmm.
of not a lot of the economic numbers, but some here and there. And then this earnings season was definitely a big change. So I'm glad you mentioned that. For it's funny how the way it works. It almost is too obvious sometimes, but like for the past 2, 3 earnings seasons, it was this is going to be the bad earnings season.
Mm-hmm.
We're going to see good numbers and have them go down. It's going to be a bad earnings season. Get ready. And it wasn't for, I
No.
guess, like almost a year now. Um, Now, and on top of, we're not going to have a soft landing. We're going to have a recession. Now, we don't have a recession. Now, consensus is soft landing. People seem to be not all bowled up again, but the total bearishness, I think, is gone. And this past earnings season was not great. We saw a lot of names have good numbers sell off. Even like Nvidia gapped up off another more or less perfect report, and that
Mm-hmm.
sold off. So that was interesting. A lot of retail got hit really bad.
Yeah.
I think Dick's Sporting Goods had, I forget what it was down percentage wise the day after they reported, but I'm pretty sure it was their worst day ever in the history of the stock.
Mm.
So that's notable. And then a lot of names too that had bad or especially bad guidance too. They
Yep,
got
I saw
punished for
that.
having bad guidance. It wasn't this, oh, this name had bad guidance, but it's getting bought up because the stock market's just going up and it's just buy. It seems
Mm-hmm.
like things that did poorly were punished properly, and then other names that did pretty well still it wasn't great. Even Apple too got hit pretty hard on earnings, and they had a couple misses. I think they missed iPhone rev, but it's Apple. Apple usually doesn't get punished like that, and it was
Mm-hmm.
fairly notable, I think. So that's another. So yeah, it wasn't a great earnings season. Based on this, it kind of feels like a rolling top. So based on that, next earnings season could be even worse. And I think, yeah, it's another sign that things might be starting to deteriorate or slow down a little bit. Yeah.
Yeah. For the market as a whole, what would you say are the key levels that you're currently monitoring?
Sure. I think I wrote a couple of these down actually. So SPY, SPY, which is what most people look at. I mean, I look at S&P futures overnight, and then SPY when I'm actually trading when the market's open. It doesn't matter too much, but I find S&P futures levels to be like the main levels that I like for support and resistance, and then I'll translate them to SPY.
Mm-hmm.
But for SPY, 444 support, 453 resistance. 453 was a level that we came off of highs, butted our heads up against a little bit, and then had this real rollover that we saw like 2 weeks ago.
Mm-hmm.
And then 444 is where we first stopped on the bounce, and then we're able to get through. That was like the level we got through on jobs number yesterday on Jolts.
Right.
So if we break 444 on the downside, that's going to negate the Jolts move. And that could signal possibly on the daily chart, we're seeing a lower high and then a possible lower low.
Mm.
If we get through 453 on the upside, it seems possible that we could see new highs for the year because it's not really a major resistance above that.
Mm.
So on S&P futures, it's 4440 and 4540. And like I said before, we're kind of like neutral right in the middle now. I remember like the weekly thing I put out for a while. I was putting the CNN fear greed was on extreme greed. It was stuck on extreme greed like all the month of July.
Mm-hmm.
We kept grinding up a little, but there were signs to just, take it easy with the buying. We should have a bigger pullback soon. We had our bigger pullback. Short-term sentiment got flushed out to the downside, whether you look at, sentiment or oscillators or anything like that. A lot of them were oversold when we bought them like 2 weeks ago. So we had our bigger pullback. Now we bounced off short-term oversold conditions. So now we're just kind of like not right in the middle, but kind of in a neutral zone.
Mm-hmm.
So it'll depend on data that comes in and everything like that. If, jobs and then eventually the Fed next month, if everything keeps going perfect Goldilocks, we could definitely see new highs again by the end of the year. And if things are starting to slowly deteriorate, then we might get a lower high on the daily chart and not necessarily turn lower, but just kind of get stuck in this chop that we're already seeing right now.
Mm-hmm.
So yeah.
Through this week, on all that jobs data, tech stocks have been kind of back in the lead. You're seeing high growth tech like ARC, top of the ETFs, Nvidia hitting
Yeah.
a new record high yesterday on that AI news. Uh, do you, looking forward, do you see, these tech companies becoming the new like leaders of the market forever, or will there be a shift back toward maybe more
Yeah.
value?
It, I mean, I think so. You're probably going to ask me what stocks I'm bullish and bearish on at some
Mm-hmm.
point later on.
Yeah.
And this kind of helps go with that. So like if I were to say I'm bullish, I would say the mega cap tech, which Nvidia isn't really like a new leader there.
Mm-hmm.
Obviously Nvidia has been around forever and they're all the hype, and they deserve all the hype. I mean, people
They've been
need
around forever, but they haven't
Nvidia.
always had that $1.2 trillion market cap that they hit yesterday.
Right,
So,
right. But
yeah.
they are doing incredible things. Their products are incredible. People need those chips. Companies need those chips. And so big cap tech it seemed like for the big FANG run, which was like 2008 to 2018, it was all about the FANG growth. Now
Mm-hmm.
FANG has become value in a way. So
Right.
from what I've seen ever since 2018 and definitely 2020 on, tech can get sold really hard because it's high beta and it moves a lot, but at the same time they have so much money. Apple, Facebook, they just print so much money that they're kind of a safety trade in a downturn, where
Mm-hmm.
if the markets push higher, QQQ usually does push well, and then when it's really risk on, you get like IWM and energy and financials and other stuff going. But then if we take a downturn, well, my favorite setup is usually buying quality in fear, and
Mm-hmm.
some of the big tech's about as quality as you can get.
Mm-hmm.
Um, it's hard to see a new leader in anything right now. We already kind of had the big energy run.
Mm-hmm.
Banks have so much drama going on. It's just hard to see them really taking anything over. Tech is the leader, but it's also had a really big run. I don't know, maybe like some other things I said were gold and silver, just because those charts look okay. Healthcare XLV looks pretty good too.
Mm-hmm.
So maybe healthcare, but I think just bigger picture, we're more on are we going to be risk on going into the end of the year, or the risk off in general for like equities as opposed to sector by sector. So yeah, if that makes sense. So I don't really see them being a new leader. I think it's hard to see a new leader right now because I think we're getting ready to evaluate whether this economy is going to actually start to turn
Mm-hmm.
lower after people have been waiting on it for years at this point. Maybe we had a slight recession in whenever it was like mid 2022 or something. I don't really think we ever had the recession. And then now that everyone's given up on the recession, it might actually be coming now. So
Yeah.
yeah.
How would you describe the current market sentiment and action that you're seeing?
Yeah, so going back to just the recent movements that we've had, I would say pretty neutral.
Mm-hmm.
Again, it was such a big run this summer. Some of the names Meta, Nvidia, some of those charts, if you like scroll out to the beginning of the year, are just like the sickest trends you've ever seen, really. So we had a huge run over the summer. I remember S&P breaking out of 4,200 back in the spring. We got to the point of getting overbought, but you don't just get overbought and then crash the next day. It has to, you have to kind of work the greed out and dip a little. People buy the dip too early, you bounce a little, then you flush those people out, and it's kind of like a domino effect. So we got over again, we got overbought. We were at extreme greed. We were looking for a bigger pullback, not SPY 1%, but SPY like 5% or something like that. We pretty much got that. We flushed out, so we actually got oversold short term. So like big picture, we got overbought. Small picture, we were overbought too. Everything was overbought. Then we flushed out, so we got like small picture oversold, medium picture a bit neutral. We bounced from that oversold in the short term, and now we're just we're pretty neutral. So yeah, I mean, it's such a data dependent market, but that's just the way it is. Because we're coming off a 14-year, huge cycle. Like this is really coming off of such a big cycle that COVID threw such like a weird wrench in that.
Yeah.
That kind of like inflated that a little bit and pushed it at the end. But it's such a big turn with rates, and we haven't had rates up here like this in a really long time. And I always read about like fund managers that have been managing funds for 10 plus years, but they've never managed money with interest rates like this. They haven't really been in these environments. You can do all your history research that you want for how it's supposed to go, but it's a new market, it's a new time. So it seems like everyone's just trying to figure out what's going on, whether you're, it's Stanley Druckenmiller or some new trader. So yeah.
You already talked about what stocks you're feeling bullish about. So tell me what stocks or sectors you're feeling bearish about at this point.
Yeah, I would say I'm not necessarily bearish on anything. I'm more just, if this happens, these should get hit harder. If this doesn't happen, these should go up more. So just like taking a glance at a few sectors, XLU utilities, that's a pretty ugly chart. Utilities tend to not do well when rates are going higher, because it's safer to buy bonds than buy utility stocks. But when rates are going down or rates aren't doing anything, utilities usually do well because they give you yield. And when you can't get yield in bonds, then you go to stocks. But that was Tina. There is no alternative, and now it's Tara. There is a reasonable alternative. So there's other places to go than just equities. So XLU looks pretty bad. If rates continue higher, that probably gets hit. But at the same time, if the data keeps coming in weak or weaker than expected, rates probably aren't going to go higher. So that could actually be like, that could be a setup where this looks like it's going to break down, but if it doesn't break down, it could be a good buy. Bitcoin in general has been trading pretty poorly this second half of the year. It's not down a ton or anything per se, but usually if you look at like the S&P and Bitcoin, the argument that they're not correlated, I think, is more or less thrown out at this point. When people are scared and they're selling things, Bitcoin is definitely going down. And if you look at the S&P and Bitcoin the past 4, 5, 6 months or whatever, especially the last like 3, the market's been holding up pretty well, and if anything, trending higher, and Bitcoin hasn't. And usually in times past, I remember for better Bitcoin runs, the market would pull back and Bitcoin would like just go sideways, and there'd always be this relative strength in Bitcoin where market's selling off, Bitcoin's not, and then it breaks out. And again, the past like 3 months or so, markets have held up well until the recent downturn, and Bitcoin hasn't. Not only has it not bounced that much, but it's been trending down. It's almost been going opposite. So I don't know what's going on there. I'm not a huge fan of crypto myself. I don't own any crypto really, I don't think. But yeah, so the Bitcoin, just the risk on vibe there has not been the vibe at all. So that probably gets hit worse if we do get a risk off scenario. And then lastly, SMH for semis. I think that just with all the Nvidia hype, although big cap tech is usually a safety play, I'm kind of thinking of like Apple and Microsoft when I think of that.
Yeah.
Nvidia's solid, but it's really expensive. It's obviously really crowded at this point. So if there
Mm-hmm.
were to be some type of risk off catalyst, whatever that may be, you might get some trap money in semis, specifically for big cap tech. Yeah.
All right. Let's go to some audience questions. Franklin, talking about higher for longer interest rates being damaging. He said it may be damaging to purchasing power for consumers and businesses. So, could we possibly see investors allocate toward other assets within their portfolio?
Yeah, that's a fair point. I mean, that's just the whole we have to hold rates higher for longer. Let's hold with the lag effect. Powell's always talking about the lag effect. I totally agree with that. And that's, again, partially why you could argue that we're still in the first half of this bigger picture cycle change correction or what have you.
Mm-hmm.
I've always been arguing that if you look historically at Fed funds rates, just like throughout the years, we hike a lot, then we hold, and then we start cutting. And if you compare that to S&P, we usually start cutting when things are actually getting bad and we need to cut and ease money. So
Mm-hmm.
therefore, based on that analogy, we're still in the first half where we haven't even really held yet. We're still like maybe raising a little bit, but we might need to hold for half a year or something like that. And then again, based on that, once we start cutting, that's when things start going poorly. The recession that everyone's been waiting for might start to happen. So that's just, like that's a pretty good example where I probably should have said that earlier, but it almost seems a little obvious. We're just money is more expensive in general.
Mm-hmm.
For now, it hasn't really seemed to affect too much. The housing market's still held up pretty well, but
The
even
housing
that
market's
seemed
crazy.
yeah, but that seems to be also slowing down a little bit. I have a couple
Mm-hmm.
friends who are real estate agents, and they'll just tell me like how things are going, and they definitely have not been as busy as they once were.
No.
Um,
Yeah.
so yeah, so that's a good point with just purchasing power and everything like that. And it's another argument to be made for a deterioration possibly to come.
Mm.
Yeah, if that makes sense.
Yeah. Franklin also said, we saw rates influence investors to favor the dollar, but shortly after saw a rushed increase in assets such as Bitcoin or gold, etc. Could positive US data be painting a rose colored view about the state of the economy?
Yeah, I mean that's what we've seen in general for the most part. So it definitely could be. I mean, so well, the dollar is funny too because everyone I feel like has been arguing for my whole career about the dollar going down and the end of the dollar and everything like that. But the
Right.
dollar I think has done better than ever this year or so, whether it's the past year, past 6 months or something like that. Um, so but then again, there's always like the argument where the dollar going up is good for America. It's money coming to America from overseas. But then there's the argument that the dollar going up is bad because it's money leaving equities and going to a more safety trade. Um, so, I mean, yes, good economic data will definitely help all of that.
Mm-hmm.
But again, just it seemed that we've had a lot of good data over the past year, almost perfect data, and it seems like
Mm-hmm.
that's starting to downturn a little bit. So we'll see. I mean, I think the medium case is we just get a bit stuck for a while, and you don't. Again, we've had this like 45-degree trend angle on equities. I guess a lot of equities for the past 6 months or so.
Mm-hmm.
So that doesn't mean we have to just go down in a big way either. People are always
Yeah.
saying, up or down. What about sideways? And for now, we're
And I
starting
feel like
to get a bit sideways.
we chopped sideways, I feel like, for a large part of the spring.
Yeah,
Uh, so kind of maybe back to that kind of sentiment of like, we can
exactly.
just kind of
Yeah,
hang out
yeah.
here
We
for a little
chopped
bit.
sideways for I think it was like 2, 3 months. It was a long time.
Mm-hmm.
It was 4,200. I always remember that level because then yeah,
Yeah.
once we finally cleared it, I forget the exact day, the exact reason that we cleared it. It was obviously
I
a
don't
lineup
remember.
of really good. I mean, just months of good economic data mixed with CPI's lower, CPI's lower, CPI's lower, and then we eventually broke up, and then now that breakout's over, and now we're consolidating again. Yeah.
Hmm. I feel personally like a lot of people in my life who maybe don't totally understand this economic data. In their mind, they think, oh, if the Fed gets inflation back down, prices are going to go back down. My grocery bill will go down. My gas bill will go down. uh,
Right.
and I think it's a misunderstanding maybe of, what inflation really is. Prices are always going up over time. Inflation getting back to 2% does not mean prices are going down. It means just prices are not continuing to go up. So how
Right.
can the Fed, hold on, the Fed needs inflation back at that 2% target. That does not mean prices are going down. That
Yep.
means, prices are still going up at, that 2% annualized rate, which is what they've determined is maintainable. But in order for consumers to be able to deal with that, we do have to see wage gains. We have to see wages increase and keep up with that inflation. But the Fed doesn't want to see wage gains. So how can the Fed kind of, let me see how I want to
How
word
can they balance it
this.
out?
How can they balance that need for
Yeah.
consumers? Because right now it's painful. I mean, personally, to go to the grocery store, it's painful. And I look at it and I'm like, wow, I'm going to have to pay this much for groceries forever. So,
Yep.
what do I do? What does the Fed do?
Yeah, I mean, that's the challenge that Powell faces. And,
Yeah.
people like to hate on the guy, but he's dealing with a lot for sure.
Mm-hmm.
And what you said hits the nail exactly with the wage growth. Again, inflation is a natural thing. Prices naturally go up. The grocery bill is definitely brutal. And it's probably not going to get that
Facts.
much better. So yeah, so you have to I mean, people have to make more money. How do people make more money? Companies have to make more money, or you know, it, or they fire people and then they have more money to give out, and we rework the labor force a little bit where
Mm.
people that were doing I mean that happened over the past year with like big tech companies, especially. It seems people at
Yeah.
I remember like the TikTok people at like Facebook and Google getting laid off. That these people are just like, oh, my day in the life of Google, making $200,000 doing nothing, like
Yeah.
basically.
Yep.
A lot of those types of people got laid off.
Mm-hmm.
Um, it's I mean it's hard, and honestly, in this country, it is also just a trend of the rich get richer and the poor get poorer. So people, like, you could argue the stock market holding up is good, and even though inflation's rising, but the stock market's going up, so like everything's fine. But something like 1% of Americans own 40% of the stock market. So the person that is struggling to pay, for diapers because their groceries just went up, they're probably not looking at their gigantic IRA and saying, well, my gigantic, IRA just went up. So who cares if I can't afford these groceries?
Right.
Because that's just like not how it works. So it's a tough question. I mean, honestly, I think if I like really had to say it, I would say that we need a bigger correction and washout that never really happens in the whole bear market. When we bottomed October of, I guess it was October of last year.
22. Mm-hmm.
Everyone was looking for capitulation, and it just never really happens. And if they can create like and Powell always says it too, with raising rates higher, and it's better to have short-term pain than long-term pain. You don't want long-term inflation. It causes
Mm-hmm.
way worse problems down the road, 10, 20 years from now.
Mm-hmm.
And that wealth gap is just going to split even more. So it's better to cause the short-term pain. I mean, let there be a washout. Let the people that were irresponsible with their money, you know, take the lesson that is ultimately probably going to come to them. Um, and then, we'll see after that washout. But it's not like the Fed wants to create a big washout or anything like that. Um, I can't really think of anything better than that, honestly, because like you said, the prices aren't going to go down. People that raise prices, they're not going to lower
Mm-hmm.
prices for the benefit of society and hurt their company or anything like that.
Mm-hmm.
So people ultimately need to get paid more, and hopefully in time, the wage growth can catch up and inflation can chill out for a bit. But it's just not, and I would always say it too, like with you, it's not mathematically possible to have like perfect inflation and a roaring economy and S&P at highs and Bitcoin at
Yeah.
highs, just that all of that will naturally create inflation.
Mm-hmm.
So it's hard. So it's probably, I mean, it's not that they need to do it, but technically what's probably needed is another year or two of pain for a bigger picture, better outlook.
Hmm.
Yeah, I guess Powell's got his
Your
work cut out for him.
yeah, he does have his work cut out for him. But last week, Josh Leffler was on the same program with me. You work alongside him in the ProDesk virtual trading floor. You guys are
Mm-hmm.
both traders, T3 Trading Group. You work closely together. He told me that if Powell can get inflation back to target without causing a major recession, he will go down. He personally thinks he'll be like the best Fed chair in history. He'll go down in the books next to Bernanke. Do you
Yeah.
agree?
Yeah, for sure. I mean, I like Powell. I think he's done a pretty good job. I've always liked him. I think, struggled. I forget what year he came on, 2018 with Trump,
17.
maybe
Yeah,
2016.
2018. Yeah.
And I remember he struggled at first. I remember everyone would call him Dr. Death because pretty much every time he would get on and speak, the market would get hit. He would just say something wrong.
Mm-hmm.
He's gotten a lot better with speaking now, but I mean, personally, I like him. I think he does a pretty good job. I not under, not that I understand what he's going through, but I kind of get what he's looking at more than just like the average person that just, needs someone to blame for everything, basically. So yeah, I definitely agree with Josh's statement on that. I think he's doing a pretty good job already. Um, we'll see though. I don't think not having a recession is totally out of the water yet.
Yeah,
We'll see. I think
I
it just takes
agree.
time, and everyone's so that's just like what traders are like. They instant gratification. Like right now, okay, we're done going up, now we're going down.
Mm-hmm.
Takes time for things to trickle out. Yeah.
I feel like I agree with you. I don't think we're out of the woods on the possibility of a recession yet. And all your big analysts that were like recession, recession, recession have now come out and said, oh, I'm wrong. We're not going to get a recession. Uh,
Right.
do you think they're wrong that we're not going to get a recession? And maybe it just took a little bit longer for the data to kind of catch up with what the Fed was doing.
The I mean, if it's a yes or no question, then I think yes.
Okay.
I think they are wrong. And just again, off just the pure analogy of the history of the Fed funds futures, where you hike, and usually we do well in hiking cycles, actually, statistically. And then we
Yeah.
hold, and then I don't know what's going to happen. I don't know like what is going to be the catalyst for when they start cutting and why.
Mm.
Um, some Fed members said they don't even see cuts next year at all. I think Goldman pushed their cut from like June to July, or maybe they moved
Yeah.
it forward. Some people think like mid next year. I don't know what the catalyst for the cut's going to be in a perfect world. It's just simply that rates are at this percent and inflation's at this percent. So you have like real interest versus,
Yeah.
if interest rates are 5 and inflation's at 8, you have like negative rates. So they
Mm-hmm.
could cut it just for that real rate reason, but that's like a
Yeah.
perfect scenario. But just based on history, after these big hike cycles, we hold and then we start cutting. And when we
Mm-hmm.
start cutting, that's when things are going poorly. And I know even like me and you talked about December 18 as an example where
Yeah.
Powell pushed it like one hike too many. We came down in October, November, and then that December, we were like red 18 out of 20 trading days that December
Mm-hmm.
2018. And that's when Powell had to step in and cut because things were,
Yeah.
starting to hit the fan a
One,
bit.
the Fed
So,
has, a dual mandate. It's not just inflation, it's also the strength of
yep.
the labor market. So if they start to see so much weakening in the labor market, but inflation, under control, then they can kind of switch gears back, focus on the labor market, bringing things back because inflation's under
Right.
control. I feel like the Fed's kind of always in this like, let's focus on this part. Okay, it's cool. Now we focus on this part. And there's always obviously the hiking, the
Right.
cutting, the hiking, the cutting for the,
And there's a lag effect to everything, and no one can
yeah.
predict the future perfectly. So if we do get that inflation level, that target, and then unemployment, the trend that they're watching starts to get a little bit out of control, then they can start cutting. But then it'll be, is it too late? And not too late, but just, then they're going to have to start aggressively easing again,
Yeah.
as opposed to like this perfect, let's just hold and let things go. So
Do you think the lag effect was maybe a little bit more pronounced this hiking cycle because of all the extra savings that consumers had from COVID,
yes.
from the stimulus checks, et cetera? So people were able to say, okay, inflation's hurting my pocketbook on a regular basis, but I have $20,000 in my savings account that I didn't have before, so something's bad.
Yeah, absolutely. Absolutely. Which is what's, that's the rolling, like we're kind of going over this rolling top, I think. And that's what makes them difficult. You don't just like there's a rolling top and then there's an extreme like parabolic top. And this is definitely more of a rolling top where it takes time and it looks like you might go up a little bit and then you might go down a little bit. And then you start to really deteriorate when kind of like all, we're never going to go down again, basically, or we're never going to have a recession, basically. And, then you start to have that. Um, so yeah, I mean, well, it's going to be interesting, I think. But there's some. I wish I had shared the chart here, but there's a chart that I think J.P. Morgan and Bank of America have been sharing for since the start of COVID about the XX savings that you're
Mm-hmm.
talking about. And I don't want to say they've run out now, but they're like about to run out. They've been projecting
Definitely
those XX
decreased.
savings,
Yeah.
yeah, running out, I think by like September, October this year.
Mm-hmm.
So then once that runs out, maybe then we start to see the people that overextended themselves on debt and leverage and everything else, they might start to get hurt. And then,
Mm-hmm.
they are forced to sell things that they don't want to sell, but they have to sell. And that's when real capitulation and opportunity comes in.
Mm-hmm.
So yeah.
Another question from Franklin. He asked if you think investors are ready to trust the Fed and the dollar.
Yes, yeah. I mean, trust the Fed. The Fed's not like lying to you. They're not some big
I think the
conspiracy
market
theory or
definitely
anything
more
like that.
now is believing the Fed is going
Yeah,
to do what the Fed says they're going to do versus thinking they know so much better than the Fed on what the Fed is
right.
going to do.
And specifically, the Fed's backed off on forward future guidance a bit. They're not
Mm-hmm.
being as specific with, whereas before they were like, okay, we are going to hike 25, we are going to hike 50. And
Totally.
now they're being more data dependent. In terms of trusting the dollar, I mean, the dollar just had like a really big uptrend over the last month or so. That's what cut us lower a little bit.
Mm-hmm.
Um, I mean, it's hard. I just think it's hard to trust anything in this market for longer than 2 weeks.
Yeah.
Because just things change. So, you could be right now, and then 4 weeks later, we have all this set of data that changes the narrative. And it's not that you were wrong, it's that you were right, but then something came out that, messed up your equation. Now you're wrong.
Mm-hmm.
Which is why I hate like, year-long S&P targets and stuff like that. Because,
Yeah.
if you're predicting up 5% for the year and at the end of the year you're up 5%, but throughout that year you went down 20%, sure, you made 5%, but if you're more strategic with it, you could have done better.
Yeah.
So I think we can trust the dollar. I think we can trust the Fed for now, but I really, really think these next, and again, going back to like the September, November Fed meeting, these next 2 months or so, I'm not calling for deterioration, but if it's coming, I think it'll start to come out more that, okay, like maybe this economy is slowing down and maybe labor is getting a bit worse and we're not just, we'll have a little downturn and we won't bounce right back from it.
Mm-hmm.
So yeah, I think these next basically into the fall, which also September and October can be rocky months for the market
Worst.
as well.
Mm-hmm.
Um, yeah, so we'll see. And I think I saw a article earlier on the dollar. September is like the best month for the dollar typically.
Interesting.
So yeah, which that would be a headwind as well if the dollar just keeps roaring higher.
Yeah. Yeah. September is, historically your worst month for the stock market. So we'll see as we're kind of
Yeah,
rallying heading into the beginning of September what kind of happens.
right.
You mentioned you think the market's kind of in a holding pattern, kind of waiting to see what's going to happen. We might get into that sideways chop that we saw kind of earlier this year. We might see that again. What do you see as possibly the next big catalyst for the market, though, whether that be up or down?
Yeah, good question. I'm just double checking what I wrote on this earlier because I didn't have like a great answer for this. It's mostly just what I just said, which is basically just how bad the downturn is going to be.
Mm,
Um, um, it's I. It seems like we really are still in the first half of this bigger market cycle where the Fed, even in a Goldilocks perfect scenario, the Fed has to be very careful about cutting too early if everything does look perfect. Because theoretically, if everything's perfect and they cut and money's super easy again and everything just roars, we probably have inflation start to tick back up, and they don't want to repeat the mistake of like the 70s or whatever,
yeah.
where they eased too early and then inflation
Hmm.
had like a whole nother leg.
Yeah.
That's
And
just
then
going
you
to
got
be
15% interest rates.
right, exactly. And then
Hmm.
that becomes like a 10-year problem.
Hmm.
Um, so next catalyst, I guess this September, I mean, we got data coming out this week. We'll have, I think, another CPI before the
Yep.
Fed September
CPI is
meeting.
September 13th, so it'll be a week
Yeah.
before. Hmm.
Um, and then the November Fed meeting, but just the data in general, where again, inflation's not that inflation's not important, but it's not as important now. Jobs, the economy, labor, the health of the economy in general seems to be more important now. Over the next month, 2, 3, we should start to see, okay, are we going to hold in okay? And then, the Fed can maybe just hold for a bit, or are things going to start to deteriorate in a way where not that we, crash by the end of the year or anything, but just that the Fed might have something to be worried about with the economy.
Hmm.
Um, so that's it really. I mean, we don't have earnings. Earnings season pretty much just wrapped up. Um, End of the summer, long weekend this weekend. Usually things start to kind of pick back up early September. And then we have, I know like Yom Kippur and Rosh Hashanah. So it's usually slow then as well. So then by like the end of September, we should start to see more movement. But I mean, we had a huge breakout higher over 4,200. Then we had NVIDIA give like the best earnings report ever. And then we
Yeah.
had the AI wave, which is kind of unexpected. Then NVIDIA gave another good earnings report, and didn't really see much upside from it. So I don't
Hmm.
know. It's kind of hard for me to say like what the next big catalyst for a big up move is going to be, because I feel like we had them. Like we had the big
Yeah.
breakout, we had this NVIDIA AI wave. So what's next? I'm not sure. It doesn't mean again that we have to turn down. Just means we have to kind of wait and see, and that's when we
Mm.
get sideways chop, and then either we chop long enough sideways and then we either break out, or something bad happens and we break down a little bit, and then we look for opportunities in the downturn.
Mm. Okay, kind of an interesting question from Mike, and I'm gonna give you a little caveat to it. He said, after working in the T3 BTF, that's the ProDesk virtual trading floor, for a number of years, do you have more respect for Derek or Josh? He said, it's okay to answer, this is a safe place. And I would guess you'd respect them both equally. But so instead of who do you have more respect for, maybe what do each of them bring to you as a trader, your relationship with them? How does working with them benefit you individually, each of them? For
Yeah.
everyone listening, when you work with T3 Trading Group, you are part of the ProDesk Virtual Trading Floor. It's just part of that. So you get to work alongside Patrick, Derek, Josh, all the traders that I've had on this event.
Yeah, good question. Definitely a mutual respect for both. They're both, I would consider, good friends as well as coworkers. Both good guys.
Mm-hmm.
Um, they bring obviously different aspects. I would say, I mean, I guess to give the highlight for each, Josh has been, he has like more experience with managing kind of bigger money, whereas he wasn't so much trading on his own, but he was managing like real funds, where he
Mm-hmm.
had to look at the bigger picture more and kind of analyze those bigger picture trends and where things might be going the next month, 3 months, 6 months, kind of like the anecdotal data of everything, and just knowing a lot of like the back end of how things work, and that comes from that experience of kind of working with a fund, as opposed to Derek, is to my knowledge never worked for a fund per se. He was always trading on his own. but
Mm-hmm.
because of that, he has more experience with the like direct technical front end platform, whether it's, charting, more so like tape reading, how like specifically stocks and the equity markets work, and not necessarily, although Derek is definitely very good with the big picture, not necessarily in the big picture, but also in the smaller, the next 5 minutes, the next 30 minutes, the first half of the day, something like that. Kind of like, I guess, day trading, although we definitely don't only day trade.
Mm-hmm.
Um, so yeah, so Josh more so bigger picture thought process, and Derek more so with like pure execution, which the two of them coming together is a perfect match because, again, you can have a thought process of the S&P is going to be 5% higher a year from now. But if you're good at executing and in that year you have a 20% drawdown and you
Mm-hmm.
buy in that drawdown, the guy
Mm-hmm.
that bought at the beginning of the year is up 5% and the other guy is up 15%. I
Yeah.
know who I would rather be.
Mm-hmm.
So yeah, so it's like a good combination of both. Um,
Mm-hmm.
yeah. So yeah, mutual respect for both, definitely.
And then before we wrap things up here, talk about your role in that room. I know you're kind of the research workhorse for all of them. So talk about that and just how that benefits your own personal trading, doing all of that work for the traders who are in that room with you.
Yeah, so I push a lot of research and news mostly in the room, as well as option flow and stuff like that. Most of it I've just learned to look for over the years, just through either, seeing someone else talk about something or seeing a stock move and not knowing why, and then looking for the headline and finding the headline and then finding who posted the headline first, stuff like that.
Mm-hmm.
And then pre-market is like my busiest time of the day. If anything, we start at like 7:30 and post a ton of stuff up until basically the open or Derek's meeting at 9.
Mm-hmm.
Um, and it just, it's part one of the reasons why I love this job, because I'm always trying to know everything about everything and read everything throughout the morning. It takes me hours every morning before the market even opens to browse through everything and read everything. But it's just being more aware of what's going on in general. You're like kind of more in touch with the market. You're not, oh, the market's up. Like, there's always a reason. Sometimes the reason is a little confusing, and sometimes it's even backwards as to why things are moving. But
Yeah.
the market just doesn't randomly go up a lot Tuesday. Like, it went up because of the JOLTS numbers. The market doesn't
Right.
randomly break down. It broke down because the VIX broke out, and VIX exposure robots are selling. Like, there's always a reason. It's not just totally random. There could be a
Mm-hmm.
lot of different reasons for why we should go up or why we should go down, clashing with each other. And then sometimes that's a reason why we go sideways, and you can predict going sideways as well.
Yeah.
So yeah, so just reading everything, being kind of in touch with what's going on, pretty much every day. You kind of have like that little bit of edge of, we went up yesterday because of this, we went up last week because of this, last month because of this. Where you're going is very important, but where you just came from is important too. And yeah, just staying kind of just like always having an ear to the streets, I guess, if that makes sense.
Mm. All right. Thank you, Patrick, for being part of this today. I hope everyone who joined us live enjoyed. I'm putting a comment in the chat now for our next event, the link for our next event. That'll be next Wednesday at 4:30 p.m. Eastern. T3 Live's Director of Education, Sami Abusad, will be joining me next week. So it'll be his first time on this program, and I think he'll have a lot of good market insight. So thank you again, Patrick, for doing this today, and we'll have you back on again in the future.
Thank you.